Welcome to Trading Smart. In today's masterclass, we're going to explore one of the most important foundations of successful trading: market structure. Before learning liquidity, order blocks, fair value gaps, or smart money concepts, you must first understand how price moves. Market structure is the language of the market. It tells us whether buyers or sellers are in control, whether a trend is healthy or weakening, and where high probability opportunities are likely to appear. Most retail traders focus on indicators, signals, and predictions. Professional traders focus on structure. Why? Because structure reveals the story behind price movement. Every higher high, every lower low, every breakout, and every reversal leaves clues about what large market participants are doing. In this lesson, you will learn how to identify uptrends and downtrends, understand higher highs and lower lows, recognize breaks of structure and changes of character, and see how institutional traders use market structure to make decisions. By the end of this masterclass, you'll have a framework that helps you read charts with confidence and understand what price is really telling you. Let's begin our journey into market structure. Now that we understand why market structure is important, let's answer a simple question. What exactly is market structure? Market structure is the framework that helps us understand how price moves within the market. Every market, whether it's Forex, gold, indices, stocks, or cryptocurrency, moves through a series of highs and lows. By studying these highs and lows, we can determine the current direction of the market and identify potential future opportunities. Think of market structure as the skeleton of price action. It provides the shape and direction behind every move that occurs on a chart. When price is creating higher highs and higher lows, the market is generally in an uptrend. This tells us that buyers are in control and demand is pushing price higher. When price is creating lower highs and lower lows, the market is generally in a downtrend. This indicates that sellers are dominating and supply is driving price lower. Market structure is not about predicting the future. It's about understanding what the market is currently doing and aligning yourself with the dominant flow of price. Institutional traders don't rely on emotions or guesses. They analyze structure first. Structure helps them identify trends, reversals, continuation opportunities, liquidity targets, and potential areas where large orders may enter the market. Without market structure, trading becomes guesswork. With market structure, every candle begins to tell a story. As traders, our goal is not to predict every move. Our goal is to understand the current structure, identify who is in control, and position ourselves alongside the highest probability opportunities. In the next section, we'll break down the building blocks of market structure and learn how to identify higher highs, higher lows, lower highs, and lower lows. Market phases: understanding the institutional cycle. One of the biggest mistakes retail traders make is believing that the market moves randomly. In reality, markets move through repeating phases driven by institutional activity and smart money behavior. There are three major phases every trader must understand: accumulation, expansion, and distribution. Let's start with accumulation. This is where institutions quietly build positions while price moves sideways within a range. The market often appears boring and directionless during this phase. Liquidity is collected from both buyers and sellers through stop hunts and false breakouts. Retail traders become frustrated because price seems to go nowhere. But behind the scenes, smart money is preparing for the next major move. Once enough positions have been accumulated, the market enters the expansion phase. This is where institutions drive price aggressively in one direction. Market structure becomes clear, momentum increases, and strong trends begin to develop. This is the phase most traders dream about because it offers the largest opportunities. Unfortunately, many retail traders enter too late, chasing the move after smart money has already positioned itself. Eventually, every trend reaches the distribution phase.
Here, institutions begin taking profits from the positions accumulated earlier. Price may start moving sideways again, creating confusion and trapping late buyers or sellers. False breakouts become common as liquidity is gathered one final time. Once distribution is complete, the market often reverses and begins a new cycle. Understanding these market phases gives you a major advantage. Instead of reacting emotionally to price movements, you begin thinking like institutions. You can identify where the market is in the cycle, anticipate what may happen next, and align yourself with smart money, rather than becoming liquidity for it. Remember this simple sequence. Accumulation builds positions. Expansion creates profits. Distribution takes profits. Master these three phases and you'll start seeing the market through the eyes of professional traders.
Now that we understand market trends and market phases, let's explore one of the most important concepts in institutional trading: break of structure, commonly known as BOS. A break of structure occurs when price breaks a significant swing point in the direction of the current trend. This tells us that the dominant side of the market is still in control. In an uptrend, buyers create a series of higher highs and higher lows. When price breaks above a previous swing high, we have a bullish break of structure. This confirms that buyers remain strong and that the trend is likely to continue higher. On the other hand, in a downtrend, sellers create lower highs and lower lows. When price breaks below a previous swing low, we have a bearish break of structure. This confirms that sellers remain in control and that the downtrend is likely to continue. Why is BOS so important? Because it provides confirmation rather than prediction. Instead of guessing where the market might go, we wait for price to show its intention. A valid break of structure demonstrates momentum, confirms trend strength, and helps us align our trades with institutional order flow. Professional traders use BOS as a filter. It helps them avoid weak setups, identify high probability opportunities, and stay on the side of the dominant market participants. The process is simple. First, identify the current trend. Second, mark key swing highs and swing lows. Third, wait for price to break one of those levels with conviction. Fourth, look for confirmation and plan your trade. Remember, smart money doesn't trade based on hope. Smart money waits for evidence, and a break of structure is one of the clearest pieces of evidence the market can provide.
Now let's explore one of the earliest signs that a trend may be changing direction. Change of character, commonly known as CHOCH. A change of character occurs when price breaks a significant swing point against the current trend. Unlike break of structure, which confirms continuation, CHOCH warns us that the current trend may be weakening and that market control could be shifting. Let's start with the example on the left. In a downtrend, price creates a series of lower highs and lower lows. Sellers remain in control as price continues moving downward. However, when price breaks above the most recent lower high, something important happens. The structure of the market changes. This is known as a bullish CHOCH. A bullish CHOCH tells us that sellers may be losing control and buyers are beginning to step into the market. It doesn't guarantee an uptrend, but it provides an early warning that a reversal could be forming. Now let's look at the example on the right. In an uptrend, price creates higher highs and higher lows. Buyers remain in control, but when price breaks below a previous higher low, the structure shifts. This creates a bearish CHOCH. A bearish CHOCH suggests that buyers may be losing strength and sellers are starting to take control. Again, this doesn't guarantee a reversal, but it alerts us to a potential change in market direction. Why is CHOCH important? Because it allows traders to identify potential trend reversals before they become obvious to everyone else. Professional traders use CHOCH alongside other smart money concepts such as liquidity sweeps, order blocks, fair value gaps, and break of structure confirmations to build high probability trading setups. The process is simple. First, identify the trend. Second, mark the key swing highs and swing lows. Third, watch for a break against the trend. Fourth, look for confirmation from surrounding market structure. Finally, build a trade plan with proper risk management. Remember, BOS tells us the trend is continuing. CHOCH tells us the trend may be changing. Mastering both concepts is a critical step toward understanding how institutions read the market and position themselves ahead of major moves. Now that we understand market structure, break of structure, and change of character, let's explore another concept used by professional traders and institutions: internal and external market structure. One of the biggest mistakes retail traders make is focusing on only one time frame. Institutions don't do that. They analyze the market from multiple perspectives before making decisions. Let's start with external structure. External structure represents the bigger picture. It is the dominant trend visible on higher time frames, such as the daily, 4-hour, or weekly chart. It helps us understand where the market is likely to go over the coming days or weeks. When analyzing external structure, we focus on major swing highs and swing lows. If the market is creating higher highs and higher lows, the overall trend is bullish. If it is creating lower highs and lower lows, the overall trend is bearish. Think of external structure as your roadmap. It tells you the direction institutions are likely to favor. Now let's look at internal structure. Internal structure is what happens inside that larger trend. It is found on lower time frames, such as the 1-hour, 15-minute, or 5-minute chart. Here we see smaller swings, pullbacks, liquidity grabs, and entry opportunities. Internal structure helps traders fine-tune their timing and identify precise areas to enter trades. Think of internal structure as the detailed route you take while following the roadmap provided by external structure. This is why both are important. External structure tells us where the market is going. Internal structure tells us how price is getting there. The highest probability trades occur when both structures align. For example, if the daily chart is bullish and the 15-minute chart forms a bullish setup, we have alignment between higher time frame direction and lower time frame execution. Professional traders follow a simple process. First, identify the external structure and dominant trend. Second, move down to a lower time frame. Third, look for internal structure setups that align with the larger trend. Finally, manage risk and execute with discipline. Remember, institutions trade with the trend, not against it. When external and internal structure work together, your entries become more precise, your risk improves, and your probability of success increases significantly. External structure gives you the destination. Internal structure gives you the path. Master both, and you'll trade with institutional precision. Now let's explore one of the most powerful techniques used by professional traders and institutions: multi-timeframe analysis. Many traders lose money because they focus on only one time frame. Institutions don't. They analyze the market from multiple time frames to understand the bigger picture before looking for entries. The key idea is simple. Higher time frames provide direction. Lower time frames provide precision. Let's start at the top. The weekly time frame gives us the overall market environment. This is where we identify the long-term trend, major support and resistance levels, and the dominant market bias. Next comes the daily time frame. Here we confirm the trend and identify important market structure levels. We want to know whether the market is creating higher highs and higher lows, or lower highs and lower lows. Once we understand the bigger picture, we move to the 4-hour chart. This is where we begin searching for opportunities using concepts such as break of structure, change of character, liquidity sweeps, and order blocks. Then we drop down to the 1-hour chart to refine our entries. This time frame helps us find precise areas where institutions may be entering the market. Finally, the 15-minute and 5-minute charts are used for execution. Here we look for final confirmation, manage risk, and execute trades with precision. Let's look at the XAUUSD example shown on the right. If the weekly chart is bullish and the daily chart confirms an uptrend, we should focus on buying opportunities. On the 4-hour chart, we wait for a valid setup such as a BOS or CHOCH. Then on the 1-hour chart, we seek entry confirmation. Finally, on the 15-minute or 5-minute chart, we execute the trade with proper risk management. This approach keeps us aligned with institutional order flow and prevents us from trading against the dominant trend. The process is straightforward. Start high, identify the trend, move down through the time frames, wait for confirmation, execute with discipline. Remember, the best traders don't force trades. They allow the higher time frame to provide direction and use lower time frames to achieve precision. When all time frames align, probability increases significantly, and that's where the highest quality opportunities are often found.
Big picture gives direction. Smaller time frames give precision. Alignment creates opportunity. As we come to the end of this Market Structure Masterclass, let's take a moment to bring everything together and review the key lessons we've learned throughout this episode.
Today, we've explored one of the most important foundations of professional trading, market structure. Market structure is much more than lines on a chart or patterns formed by candles. It is the language of the market. It tells us who is in control, where price is likely to go next, and how institutions interact with liquidity. We started by understanding that markets move in 3 primary conditions: uptrends, downtrends, and consolidations. An uptrend is formed when price creates higher highs and higher lows, showing that buyers are in control. A downtrend is formed when price creates lower highs and lower lows, showing that sellers are dominating the market. And during consolidation, price moves within a range as buyers and sellers battle for control before the next major move begins. Understanding these simple concepts allows us to stop guessing and start reading the market objectively. We then explored the market cycle itself. Every market moves through phases of accumulation, expansion, and distribution. During accumulation, institutions quietly build positions, while most retail traders see a boring sideways market. During expansion, price moves aggressively in one direction and creates the trend that most traders notice. Finally, during distribution, institutions begin taking profits while many retail traders are still chasing the move. Recognizing these phases helps us understand where we are in the larger market cycle and prevents us from entering too late. Next, we introduce 2 of the most important concepts in modern market structure analysis: break of structure and change of character. A break of structure, or BOS, occurs when price breaks a significant swing point in the direction of the trend. This tells us that the trend remains healthy and that smart money is likely still participating in the move. A change of character, or CHOCH, occurs when price breaks a key swing point against the current trend. This is often one of the earliest signs that market control may be changing and that a potential reversal could be forming. Understanding the difference between continuation and reversal is a skill that separates professional traders from emotional traders. We also learned the difference between external structure and internal structure. External structure gives us the big picture. It tells us the dominant trend and helps us understand where institutions are likely positioning themselves. Internal structure gives us the details. It helps us identify precise entries, liquidity events, and short-term opportunities within the larger trend. When these 2 structures align, the probability of success increases significantly. This naturally led us into multi-timeframe analysis. Professional traders do not rely on a single chart. They start with higher timeframes to identify direction and then move down to lower timeframes to find precise execution opportunities. The weekly chart provides strategy. The daily chart provides direction. The 4-hour chart provides setups. The 1-hour chart helps refine entries. And the 15-minute and 5-minute charts are used for execution and risk management. This process allows traders to trade with the market rather than against it. But perhaps the most important lesson from today's episode is this: knowledge alone does not create profitable traders. Execution does. The best traders follow a repeatable process. They identify the trend, mark important levels, wait patiently for confirmation, manage risk professionally, and remain disciplined regardless of emotions. Trading success is not built from one trade. It is built from hundreds of well-executed decisions repeated consistently over time. When you understand structure, you stop chasing candles. When you understand structure, you stop reacting emotionally. When you understand structure, you begin seeing the market through the eyes of institutions. And that is where true confidence begins. As you continue your trading journey, focus on mastering these foundations before moving to advanced concepts.
A strong foundation creates consistency. Consistency creates confidence. And confidence creates long-term success. Thank you for joining us for episode 2 of Trading Smart. In our next episode, we'll take the next step into the world of smart money concepts, where you'll learn how institutions use liquidity, order blocks, fair value gaps, and market inefficiencies to move price and create opportunities. Until then, stay disciplined, stay patient, keep learning, and remember, trade with intelligence, trade with discipline, trade with structure, and always trade smart. The crowd follows price. Professionals follow structure. Become the trader who understands the difference. We'll see you in episode 3.
Thank you for joining us on this Market Structure Masterclass. Today, you've learned how smart money moves the market, how to identify trends using structure, how to use BOS and CHOCH, and how to align multiple timeframes for higher probability trading opportunities. Remember, successful trading isn't about predicting every move. It's about following a process with discipline and consistency. Keep learning, keep practicing, and keep improving. Your trading edge is built one lesson, one chart, and one trade at a time. Thank you for being part of the Trading Smart community. Trade with intelligence, trade with discipline, trade smart. Congratulations on completing episode 2 of Trading Smart. Today, you've learned how institutions leave footprints in the market through structure, trends, and price movement. You've discovered how BOS, CHOCH, multi-time-frame analysis, and disciplined execution can help you trade with greater confidence and precision. But remember, knowledge becomes power only when it's applied. Review these concepts, practice them on your charts, keep a trading journal, and focus on continuous improvement. Your journey to becoming a consistently profitable trader has already begun. Keep learning, keep improving, keep trading smart. We'll see you in the next episode.